You watch a bullish pin bar form perfectly. You buy in, feeling confident, only to see price grind sideways and immediately hit your stop loss. This chart shows standard retail execution. You enter a buy order at the candle close, placing a stop loss exactly below the wick, but the market sweeps low, triggering that stop loss before the real move finally takes off. This recurring sequence highlights a specific behavior where price seeks out clusters of retail stop losses before continuing the broader trend. This environment is a liquidity trap, a specific mechanic where retail sell orders provide the necessary volume for institutional buy orders. Institutional traders dealing with massive positions can't just click buy like retail traders do. They require thousands of opposing sell orders to absorb their trades without causing massive price slippage. Those retail stop losses sitting below a textbook pin bar convert into sell orders when triggered. This cluster provides the liquidity an institution needs to quietly accumulate a massive long position. Treating every long wicked candle as a simple buy signal places you exactly where larger players look for fuel to fill their positions. Valid institutional signals require a specific professional-grade anatomy that filters out random market noise. This diagram compares a weak signal with a proper one. The rejection tail must be at least 3 times the candle's body. This proves price hit massive opposing volume and was violently shoved back. The opposite nose should be non-existent, signaling a clean rejection. Meeting these physical requirements distinguishes a genuine institutional rejection from the minor price hesitations seen in choppy, sideways markets. Shape alone is insufficient. Context determines validity. A pin bar formed during the low-volume Asian session lacks the institutional conviction needed to drive sustained moves. You should also avoid trading against a high-momentum God candle. Momentum is like a freight train, and a single pin bar rarely stops it. This chart applies dynamic support and resistance using the 8, 21, and 200 exponential moving averages. Notice how this pin bar rejects the 21 EMA, confirming the short-term trend. The most effective setups also occur at psychological round numbers, like 1.1000, where institutions hunt stops. A candlestick shape is only actionable when it aligns precisely with these institutional confluence zones. To trade like a professional, you must move beyond market close entries and use a 50% retracement strategy. This diagram illustrates the technique. Instead of buying at the close, you place a limit order exactly halfway down the pin bar's tail. Entering at the close typically requires a 40-pip stop loss to target an 80-pip move, resulting in a 2-to-1 risk-to-reward ratio. Entering at the midpoint cuts the initial risk in half. That same 80-pip profit target now offers a 4-to-1 return on your risk. Because this entry requires a specific pullback, the market will occasionally move without filling your order. About 30% of these setups will be missed. Professional trading is built on this mechanical, asymmetric edge, rather than the attempt to capture every market fluctuation. The final tactical step is positioning your stop loss to withstand algorithmic stop hunts. Since price often peaks just past a previous low, place your stop loss 5 to 10 pips slightly below the absolute tip of the wick to avoid being swept out by minor volatility. This creates a robust blueprint. Look for strict visual anatomy, verify it against institutional confluence, optimize your math with a 50% entry, and apply a padded stop. You can apply this strategy today. Download our pin bar confluence checklist and test the 50% limit entry using the 0.0 pip spreads available on an FXNX demo account. By adopting these precise filters, you move from acting as market liquidity to consistently trading alongside it.